Good afternoon, everybody. Welcome to the Taurus monthly market review. So financial markets saw a dramatic V-shaped recovery in April as the war in Iran de-escalated significantly. Active bombings from both the US and Iran came to a stop as Pakistan successfully brokered a conditional two-week truce, which continues to hold as peace talks collapse over the zero enrichment nuclear demand from the US. With President Trump officially informing Congress on May 1st that hostilities have terminated, the war now shifts from a hot one into one of an economic nature, where on the one hand, the US is blockading Iranian exports and preventing almost $6 billion of oil revenue to Iran and dealing pain to its domestic economy. And on the other hand, Iran continues to hold the world hostage by restricting oil trades through the Straits of Hormuz. In another historic event, the UAE withdrew from OPEC. This represents the most significant departure in OPEC's history, as the UAE is its third largest producer. The UAE, I think, has grown increasingly frustrated with OPEC quotas that cap its output at 3.4 million barrels per day, despite their massive investments to reach almost 5 million barrels per day capacity. UAE oil has a much lower break-even, below $50 per barrel, and that allows the UAE to prioritize volume over price, especially as global demand may potentially plateau in future due to the EV and energy transition. This development should be negative for oil price, but the immediate impact of the exit is masked by the current war. But for sure, once transit on the Straits normalizes, the UAE's independent pumping of oil could actually add 1 to 2% to global supply and potentially driving prices down towards the $60 per barrel by 2027, according to some analysts. Central banks, we had a lot of central banks that actually deliberated and gave us the rate decision in April. And most of them have adopted a cautious wait-and-see approach as they held rates unchanged. Basically, they're caught between the impact of the war on economic growth and on the one hand, on the other hand, oil prices and going up and persistent inflation. So in all, I think in all central banks, we have observed a dissent growing as to the policy paths ahead. If you look at the FOMC, the decision was 8-4 vote, the narrowest split in 23 years in its history. We had 3 dissenters and three officials actually dissented by opposing on the easing bias language, arguing that persistent inflation might require future hikes ahead. In the ECB, I think 2 policymakers explicitly opened the door to a June rate hike, a very hawkish shock that defied market expectations for continued easing. In the BOJ, we have 3 board members that dissented as well, calling for an immediate hike to combat the Japanese yen weakness and energy-driven inflation. Lastly, we are in the midst of the earnings season, and S&P 500 saw a massive 27% earnings growth so far in the first quarter of 2026, and this is the highest growth rate since late 2021. All in, I think 63% of S&P companies have reported earnings, and among these 63%, more than 80% of these companies have beat revenues and EPS expectations. This is the highest trend since the global economy emerged from COVID. So the strong earnings season indicates that market fundamentals have decoupled from geopolitical concerns, where corporate profits are actually driven more by the AI theme of cost efficiency as well as successful AI monetization. Analysts are predicting earnings growth of 21% in 2026, and that is up from 18% forecast just 2 weeks ago. So looking at the equity markets, I think a powerful rotation back into risk assets has propelled a V-shaped recovery in global equities as well. KOSPI and the Nikkei were the 2 worst performers in March, as both countries were heavily reliant on Middle Eastern crude. Of course, as geopolitical tensions ease, the rebounds are expectedly the sharpest as well. KOSPI is up 30% last month, Also helped by the fact that the two biggest companies, Samsung Electronics and SK Hynix, accounted for 45% of the index, and both companies reported record shattering results, collectively generating close to $60 billion in operating profits, as demand for their high bandwidth memory chips for AI data centers remains insatiable. Nikkei was up 16% as the focus now returns to the LDP's plan for about $140 billion of fiscal stimulus, tax cuts, and aggressive growth policies. There are also some Japanese chip giants like Advantest and Tokyo Electron that also enjoyed the AI-led boom that we have seen. Chinese markets saw modest gains by comparison, only up about 4 to 5%. There are reports that Beijing plans to restrict top AI startups from accepting US capital without government approval to dampen enthusiasm for Chinese technology names. And an intense domestic price war in cloud and AI model services continues, and that's compressing margins across the board. In fixed income markets, US Treasury yields remain elevated after rising significantly in March. This is driven by inflation worries and geopolitical tensions. The 10-year US Treasury yield gained mildly in April, but still reached a 9-month peak of 4.43% after the FOMC meeting. I think a hawkish Fed descent suggested rates would likely stay higher for longer. Within the fixed income space, the bank AT1s outperformed at the back of solid bank earnings. With higher yield carry, they provided sufficient income to more than offset the rise in treasuries. High yield also outperformed investment grade segment, as high yield bonds generally have a shorter duration of around 3 years compared to IG bonds. High yield market also have seen substantial weighting in the energy sector, and that's about 11%, which has performed exceptionally well with a rebound in oil prices last month. Moving to other assets, I think oil gained despite the end of hostilities because the Strait of Hormuz remains effectively shut. In fact, the situation now is made worse by the addition of the US blockade, so effectively sealing any trade flows from the Straits. We have seen gold and silver losing ground as higher oil prices led to higher yields and reduced the appeal of these precious metals. Copper gained about 5.6%, rebounding from actually March losses. As traders focus attention on the AI trade again, copper is essential for the build-up of AI data centers in most of them. So Bitcoin climbed 12% to achieve its strongest monthly gain in the year. Although analysts do caution that the rally rests on a very shaky foundation, there are data that suggests that the rally is due to speculative positioning rather than fundamental accumulation. Hence, I think Bitcoin could be vulnerable to a sharp downturn if an unwind of this leverage position is triggered. The US dollar was generally weakened as traders unwound safe haven trades and redeployed into risk assets. As mentioned, I think the yen experienced extreme volatility at the end of April, actually weakening past the 160 psychological level for the first time in decades. The rapid depreciation of the currency most likely driven the Bank of Japan to intervene, and as we have seen, I think we are now way below that $160 level. The fear and greed index collaborate what we have seen in the V-shaped recovery, rebounding from extreme fear just 1 month ago to greed. Probably some upside left before we head into extreme greed territory, where we need to turn cautious from a tactical or trading perspective. So I think in this week's presentation, I just want to refocus our attention on oil by giving an update on the Gulf oil situation in terms of production and what to expect in terms of scenarios and expectations for when the oil market can return to normalcy. So these are all from Goldman Sachs research, and the chart shows Goldman's oil price projections using two key variables. Firstly, when will the oil flow return to normalcy along the Strait of Hormuz? And secondly, the degree of scarring to oil wells. So actually, scarring is a term that refers to the permanent impairment of an oil well to produce oil. In this case, right, it's due to a prolonged shutdown that we have seen so far. Basically, when an oil well remains idle for too long, the reservoir pressure can change, and that can permanently reduce flow. Also, infrastructure like pipelines and pumps can also suffer from corrosion or the lack of maintenance, right, making it difficult to return to full capacity. So that's the definition of scarring. If you look at the compilation from Goldman Sachs, the good news at least is that only 1% of the daily oil production in the region is physically damaged by Iranian strikes, and most of them are in Saudi. So, in terms of the producing capacity and infrastructure, we still remain largely intact. If you look at the gray line, which is what the forward implied market expectations are, the market is probably, seeing the Straits of Hormuz reopening earlier than in June. And in that scenario, we should expect the oil price to fall below $80 by year end. Goldman's base case scenario, which is the blue broken line, which is a bit more bullish, only seeing the reopening of the Straits by end June. In which case, we should see Brent trading above $90 per barrel. But in the report, they did say that the risks are skewed to the upside, and assuming flows only recover by end July, and also to the degree of extent of the scarring or the damage to the oil wells, right? The Brent can trade even above $120 in the worst case scenario. So what does this mean, I guess, for the impact on inflation going forward? So similarly, Goldman updated their inflationary impact based on the previously the revised oil price forecast that you have seen previously. So in all cases, if you look at how the dotted lines shoot up and then start to moderate, inflation is expected to moderate by fourth quarter this year. On a base case scenario, which is what you see on the right, the blue broken line, core PCE will top up slightly above 3% this year, but will trend towards the low 2% again by the first quarter of next year. All this rests on the assumption that oil price inflation is transitory, which is largely the observed norm that we have seen in the 40 decades post 1980s. So oil price spike up, but it generally do retreat when that supply shock is removed. Oil price spike generally a one-time blip, and this will lead to the headline inflation fading within that 12 or 24 months. So based on what we see above, we do not think that there should be a lasting impact on inflation. In terms of implications to market, I think we have seen most central banks holding rates unchanged while adopting a wait-and-see approach rather than raising rates to anchor inflation expectations and risk the growth slowdown. So given that oil price spikes are largely temporary, as we have seen, and the impacts on inflation to be transitory, the decision so far may seem to be the right one. However, the impact of higher oil prices now will be felt for the rest of the year. So that removes all expectations of rate cuts this year. Having said that, I think we should not. This should not hamper returns in asset class, especially equities, as long as earnings growth that we have seen very strong is delivered. Second point, we are in the first quarter season where more than 60% of the companies have reported earnings, and by far, I think most companies have surpassed expectations. As a result, we see full year earnings growth rate being upgraded. I think now we look at the growth rate, we begin the year at 15%, and now after the earnings season so far, we have upgraded that earnings growth rate to 19% really. So investors are definitely going to look at this strong earnings growth and earnings upgrade, which I feel will be the primary source of equity market returns or market returns this year. So higher earnings growth, especially in the technology and energy sector, has made the market less sensitive to oil price-led inflation. Typically, strong profitability in the technology sector help to absorb, some of the high input costs without, seeing some margin erosion. So earnings strength, lastly, is also starting to broaden out into the materials, financials, and energy sectors, giving the market rally a more well-balanced base going forward. Lastly, this is the calendar for the week in terms of the macroeconomic picture as well as the earnings calendar. On the macroeconomic front, we had some market closures in China and Japan. Japan remains largely closed to Wednesday. In terms of the big economic decisions, we do have the Royal Bank of Australia that is going to give its decision tomorrow, and they are expected to hike rates by 25 basis points. We are starting the new month, so in the US, we typically get payroll jobs data numbers, which is what we will see. The private numbers will come in on Wednesday, but the more important one, which is the government payroll numbers, that will come in on Friday. In terms of the earnings calendar, we still have some key technology names that are reporting. I will just highlight a few. AMD will report on Tuesday. ARM Holdings, which is also relatively a chip maker now, they are reporting on Wednesday. In terms of other big cap names to look out for, we have Walt Disney on Wednesday, McDonald's on Thursday. And I'll just close by saying that tonight we do have a Palantir, which is also AI and a software darling of the past. They will be reporting earnings after market tonight. That's all we have for the monthly market review. Thank you for your interest and attention, and we hope to see you next month again.